Ever found yourself scrolling through your banking app late at night, staring at your savings and wondering why they're barely growing? You've got a few thousand sitting there, but the interest is so tiny it's practically invisible. Meanwhile, the news is full of rising grocery prices, higher rents, and vacations that cost way more than they used to. Your money is losing value, like an ice cream cone melting in the sun. The truth is, just saving money isn't enough anymore. If you want to protect your financial future or build real wealth, you need to make your money work for you. Now, I know what you might be thinking: the stock market? That sounds complicated and scary. You're picturing confusing charts and Wall Street traders yelling into phones. But what if I told you that investing doesn't have to be like that? You don't need to be a finance pro or check the news every 5 minutes. You just need one simple tool that gives you access to the power of the stock market without the stress and without huge costs. That tool is called an ETF. In this video, we're going to break it all down. We'll cover what an ETF actually is, why there's such a powerful option for most people, which ones make sense to invest in, and how to get started. By the end of this video, you won't just understand the hype, you'll feel confident enough to take your first steps. So, what exactly is an ETF? The letters stand for Exchange Traded Fund. Sounds fancy, but the idea is incredibly simple. It's a big basket of stocks that you can buy with a single click. Think of it like this. Buying a single stock is like buying one apple. It's great if that apple is fresh and tasty, but not so great if it goes bad. An ETF, on the other hand, is like buying the entire fruit basket. You get apples, bananas, grapes, pears all mixed together. If one piece of fruit isn't great, it's no big deal because you have plenty of others. That's exactly how an ETF works. Instead of betting on a single company, you're automatically investing in hundreds, sometimes even thousands, of companies all at once. And the best part? You don't have to pick them yourself. So why have ETFs become almost unbeatable for so many investors? There are 3 huge reasons. First, they are incredibly cheap. While actively managed funds might charge you 1.5% per year, most ETFs cost less than 0.3%. That might sound like a tiny difference, but over 20 or 30 years, it adds up to thousands of dollars more in your pocket. Second is diversification. You know the old saying, don't put all your eggs in one basket. With a single ETF, you instantly own a small piece of hundreds of different companies. If one of them fails, it barely makes a dent because the others balance it out. And third, simplicity. ETFs are the ultimate set-it-and-forget-it investment. Once you've chosen your ETF and set up your investment plan, you barely have to do anything. No stock picking, no trying to time the market, just automatic investing that runs quietly in the background. ETFs sound amazing, and for the most part, they are. But they aren't the perfect fit for everyone in every situation. So, who should invest in ETFs? ETFs are great for you if you have a long time horizon. This isn't a get-rich-quick scheme. It's a slow and steady path to building wealth. You should be prepared to leave your money invested for at least 15 years, ideally longer. You should also have an emergency fund set up first that has 3 to 6 months of living expenses in a safe, accessible savings account. This fund is your safety net, so you won't be forced to sell your investments at a bad time. ETFs are also one of the most effective tools for building your retirement savings and are perfect for anyone who doesn't want to spend their free time babysitting their investments. On the other hand, ETFs are not ideal if you need that money in just a few years for a big purchase like a house or a car. They're also not for you if you tend to panic when you see your account value drop. Because, trust me, it will drop sometimes. And if you're living paycheck to paycheck with no savings buffer, focus on building that first. The golden rule is simple: only invest money you can afford to leave alone for the long term. Alright, let's get to the practical part. How do you go from "I want to invest" to actually owning your first ETFs? It's a simple 3-step plan. Step 1. Open a brokerage account. Think of this like a digital safe where your investments are stored. The good news is that many online brokers and banks offer free accounts. Look for one with low fees that lets you set up monthly investment plans easily. Opening an account is usually quick. You can do it online in less than 20 minutes. Step 2. Choose your ETF. Don't overcomplicate this. A simple broad market ETF, like one that tracks the MSCI World Index, is a fantastic starting point. It gives you exposure to thousands of companies across the globe. Just be sure to check the total expense ratio, or the lower, the better. And a pro tip: every ETF has a unique code called an ISIN. Use that code to make sure you're buying the exact fund you want. Step 3. Set up an investment plan. This is where the magic happens. Decide on an amount you can comfortably invest each month, whether it's $50, $100, or $200. Your broker will then automatically pull that money from your bank account and buy ETF shares for you month after month, rain or shine. This is called dollar cost averaging, and it takes the emotion out of investing. You'll buy more shares when prices are low and fewer when they're high, smoothing out the bumps over time. Once it's set, your wealth builds itself in the background while you live your life. Now, for a classic question: what if you have a lump sum of cash, say $10,000, sitting in your bank account? Should you invest it all at once or spread it out with a monthly plan? Investing it all as a lump sum gets your money working in the market immediately. Statistically, this often leads to higher returns because, historically, markets tend to go up over time. But it also takes guts. Imagine investing $10,000 today and the market drops 10% tomorrow. That can be tough to stomach emotionally, even if you know it will recover. A monthly plan, on the other hand, feels psychologically safer. You don't have to worry about timing the market perfectly. You average your entry price over time, which reduces the risk of buying everything right before a dip. It might not always beat a lump sum in pure returns, but it helps people stay invested, which is the most important thing. Of course, you can also use a hybrid strategy. Invest half of your lump sum now and put the other half into a monthly plan. The best choice is whichever one keeps you comfortable and consistent. You might also be wondering how ETFs stack up against other options. Savings accounts are safe, but their interest rates rarely beat inflation, meaning your money actually loses purchasing power over time. Real estate can be a great investment, but it requires a huge upfront cost and a lot of hands-on work. Insurance and pension plans often come with high fees, low returns, and very little flexibility. But ETFs, by contrast, offer low costs, high diversification, and historically strong long-term returns, all while being easy to buy and sell. Each option has its place, but for accessible long-term growth, ETFs are hard to beat. And that brings us to the secret superpower of investing: compound interest. It's the concept of your returns earning their own returns. It's like a snowball rolling downhill, getting bigger and bigger. Let's say you invest $200 a month. After 10 years, you've put in $24,000. But even with a great tool like an ETF, there are common mistakes to avoid. The biggest one is selling in a panic when the market drops. If you do that, you lock in your losses. History shows that markets recover, but only if you give them time. Another mistake is being too narrow, for instance, only investing in one country. Go global with a world ETF to spread your risk. Also, avoid chasing hot trends. Stick to your broad, boring planets, far more effective in the long run. And finally, don't invest without a plan. Know your goals, your timeline, and stick to it. Let's be real, getting started can feel intimidating. But here's the truth. Nobody can predict the market's short-term moves. What we do know is that over the last 100 years, it has always trended upwards. Every month you wait is a month of lost compounding. ETFs aren't a gamble. They are a simple, powerful, and proven tool, and you don't need to be rich to start. You just need to start. So here's your challenge. Open that account, choose your ETF, and start your plan even if it's just $25 a month. Your future self will thank you for it. Financial freedom isn't about luck. It's about the small, smart decisions you make today. Thanks for watching. If you found this guide helpful, please give it a thumbs up. And don't forget to subscribe for more videos to help you on your financial journey.